Hi class, we're just getting into this concept of having variables or variances, and it starts out at the pretty much the end of the chapter. It starts talking about this master budget, and we've been doing a budget for chapter 10, and this question is going to ask you to prepare an income statement performance report with a master budget comparing the actual results to the what's called the flexible budget and the master budget. So to begin with, just to simplify this, we're going to fill in this table. And if you look in this first column, it says the actual results. So I'm looking at the actual results. I clicked on the data table. The first data table gives you the actual income statement. So I just brought this information over to here. So we sold 50,000 units. I had sales revenue of 160,500. Here are my variable expenses, and here are my fixed expenses, and finally my operating income when I subtracted my expenses from my revenue. Okay, so it's simple enough. It just gives you the actual results when you sold 50,000. Now, it also gives me a flexible income budget, and I'll start here at the master budget. So at the beginning of the year, you had to come up with some kind of idea on how you're going to perform. And so I copied the numbers down from the master budget, starting with 45,000 units. That's what I had predicted I would sell. Sales revenue, variable expenses, and fixed expenses. The flexible budget comes from the column where if I had 50,000 units, this is what I would predict the revenue would be, the variable expenses, and again, the fixed expenses would have been the same. So now I have to actually go in and calculate what are the variances. So you can see as I go across here, this is 0. This volume variance, I sold 5,000 more than I anticipated, and that makes this a favorable variance. I now compare my actual and my flexible budget. This looks like it's 8,000. Because my actual sales revenue is greater than my flexible budget, that's a favorable amount. For the volume variance between the master budget and the flexible budget, that's 15,250. That's also favorable. And it's favorable because I sold 5,000 extra units. The cost of goods sold is 500 between the actual and the flexible budget. It's unfavorable because when costs are greater than the anticipated flexible budget, it's unfavorable. These will all be unfavorable because I sold more units. It means my variable costs are unfavorable. The flexible budget, now I'm comparing 90,000, or this should be 9,000, and 7,500. So again, I have 1,500 more in expenses than I expected. That's unfavorable. Between the volume variance and the master budget, I have sales commission of 750. That's unfavorable. Go here. The utility expense is the same, so that's neither favorable or unfavorable. It is 1,000 difference though between the master budget and the flexible budget. Again, that's unfavorable. Now I look at the fixed costs, and it's 2,200. There was more fixed costs in the actual than the flexible. These will all be 0 because notice my master budget and my flexible budget for fixed costs all say that they're the same. Of course, when I get to the end of it, I will have $8,000 difference as far as my total expenses. That's unfavorable. And I got that by simply adding up these variable expenses. Going back to the flexible budget, the difference between 20,000 and 20,000, again, this one is 0. This one has a difference of $450. It's favorable because the cost for rent expense ended up being less than I anticipated. The utility expenses turned out to be the same. Now I can add up all of these expenses and the variance between, or I could just use 147,750 minus 144,000. That's 3750. This is an unfavorable amount. And my operating income then is 4250. I'm taking the favorable sales revenue of 8,000, subtracting the unfavorable expenses of 4250, and that's favorable by 4250. Now I look at my flexible budget. My flexible budget has $8,500 operating income. My master budget shows 1250. I have 7250, and that is favorable. And hopefully I've filled in this table. The actual is given. The flexible budget with 50,000 is given on this row right here. The master budget is given here. And then I just have to compare back and forth to get the favorable or unfavorable for both the sales revenue, the variable expenses, and the fixed expenses. Okay, then I'll let you figure out then the rest of the problem on your own.